This chapter deals with the market demand curve, and we answer the question how we can construct the demand for a certain good in a given market out of the individual demand functions of the people in the economy. We start this by depicting the graph that we already had in the chapter on individual demand curves. The demand of person A, you can again assume it's for cinema tickets, where we have the price on the vertical axis and the quantity demanded on the horizontal axis. Now, since we construct demand in the market, we denote the total quantity by uppercase Q. As we will see later on, that's the sum of all the individual demand levels, lowercase q. So the demand curve of person A was downward sloping. And now assume that we have a second person in the economy with also a downward sloping demand curve. Now we can add these two demand curves to get the market demand curve if this market consists only of two people. So we add these two demand curves and get to the market demand curve for the particular good under consideration. To see this, we have here the quantity demanded by person B and here the quantity demanded by person A. And if we sum them up and assume that this market only consists of these two persons, we get the quantity demanded by both persons, which would be the market demand curve for the particular good under consideration, in this case, the cinema tickets. So now we've constructed this market demand curve out of the individual demand curves of the two individuals that we considered. And we now ask what happens if the price changes of the particular good that we are interested in. So we start with a price P1 and an associated quantity Q1, and now the price of the good increases to P2. So in our case, cinema tickets become more expensive. Now what would happen, of course, individuals would consume less because their demand curves are also downward sloping, and aggregate demand for this particular good, so market demand for this particular good, would decrease from Q1 to 2Q. So again, we see price changes lead to movements along the curve. And again, we see it's reasonable to have a downward sloping demand curve. What happens, however, if something else changes in the market? For example, we have a general income increase, or we have demographic change, population growth, more individuals enter the market and enter the economy. In this case, we would have a shift of the demand curve to the right. So for each price level, we would have a higher demand level. So here for price P1, we would have more demand because there are more individuals, or the individuals have a higher income, and therefore the demand curve would shift to the right. In reality, of course, we would have many different individuals in the economy, thousands, millions, or at the worldwide level, even billions. And so we have to add their demand levels up to get the market demand curve for this case. And since also individual demand curves tend to be nonlinear, we would realistically also end up with a nonlinear market demand curve. And that's what we've depicted here again. It's downward sloping. For a low price level, the quantity demanded is high. For a high price level, it's low, but it is not necessarily zero because it could be a necessary good. So that even for a high price, people may need to consume it, and therefore perhaps this function only approaches the horizontal line for a very, very high price. So we can again summarize: market demand curves are the sum of the quantity demanded of all individuals in the market. And also these market demand curves, of course, are downward sloping. So if the price changes, then we have a move along the demand curve. So if the price becomes higher, we have a lower demand level. And if the price becomes lower, we have a higher demand level. And if the income level or the population size changes, we would have a shift of the curve. So if we have more people in the economy or they have higher incomes, we would have a shift of the demand curve to the right. So for each price level, we would have a higher quantity demanded. And if the population shrinks or the income level shrinks, then the demand curve would shift to the left. And for each price level, we would have a lower demand level. And again, realistic demand curves tend to be nonlinear.